Have you ever wondered what actually moves the Forex market? It's not magic, neither is it guesswork. It is pure fundamental analysis. So in this video, I'm going to show you 5 hidden forces that actually moves the market. So understanding what moves the market is also means understanding currency strength. Now, currency strength is understanding the value of a country's currency compared to other currencies. So think of it this way, like currency is like a muscle. So stronger muscles can lift stronger weight, while weaker muscles can only lift smaller weight. So the bigger weight we're talking about is huge investors, right? So once you have a strong currency, definitely you're going to have great investors that are going to come into the system. So let's get right in. So the first one is interest rate. Now, what is interest rate? Interest rate is the percentage that dictates how much interest you earn on a financial product. High interest rate means that you earn more on your investment. A low interest rate means you earn less on your investment. For instance, you have two banks, Bank A and Bank B, right? Bank A says they're going to pay you 10% interest for every amount you save, and Bank B tells you that you're going to earn 2% interest for every investment you make. Now, which one are you going to choose? Of course, it's going to be Bank A. And the reason why you choose Bank A is because Bank A tends to give you more interest rates, which leads to more earning compared to Bank B. A real life example is in the year 2022, the US Federal Reserve raised the interest rate to fight inflation. So this actually caused the US dollar to be stronger than a lot of pairs like the euro and yen, which lead to a lot of investors coming in to invest because of the high interest rate they're going to get in return. So the second one is inflation. So what is inflation? Inflation is the rate at which price increases over a given period of time. So in the overall sense, inflation measures the overall increase in price of a nation or the cost of living over a nation in a given period of time. For instance, if a particular product costs $100 and next year it costs $150, that's a clear example of what inflation actually looks like. So an example of the real life situation is a country called Zimbabwe in the year 2000. Their currency, which is Zimbabwean dollar, lost its value so much that a loaf of bread cost millions of Zimbabwe dollars. So this led to a lot of people losing trust in their currencies. Then also you talk about Turkey. Turkey in the last few years had a crash in their currency of over 80%, which led to their currency value going down so low. So the next one is GDP. So what is GDP? The full meaning of GDP means gross domestic products, which is the monetary measure of the market value of all the final goods and services produced and rendered in a specific period of time. So you can also see it as the total value of everything a country produces in a year, whether be it goods, services, tech, farming, and everything. A country with a growing GDP is like a student getting all A's. Investors love it and it shows the country is productive and stable. For instance, in the year 2020, during COVID pandemic, many countries' GDP fell, but by 2021, the US and China pulled strong GDP rebounds, making its currency strong as investor confidence returns. So the fourth one is employment data. So what is employment data? Employment data is the percentage of the working age individual that are currently employed, which represent the portion of a country that are currently active in the labor market. So what this means is that they are measuring how many people have jobs and how many people don't have jobs. So this actually helps the economy to grow because when a lot of people have jobs, they tend to buy more things, right? Which also leads to them paying more taxes, so therefore growing the economy. So in October 2023, the US showed over 330,000 new jobs were available. So this actually led to increase in the currency value, which led a lot of investors to come in and invest. So the fifth one is geopolitical events. So what is geopolitical event? It is the study of the influence of certain factors such as geography, economics, and the demography of the politics of a particular nation. To break it down in simple terms, geopolitics just has to do with the big world events. Events such as elections, such as wars, peace deal, and as far as going as and natural disaster. So this actually changes the way how people feel about the currency of a particular nation. For instance, when Russia invaded Ukraine in the year 2022, a lot of investors pulled out their investment from these countries and went to a safe place to invest, such as the US dollar and the Swiss francs, which actually made those currency pair actually increase in its value. The other example is when in Brexit 2016, the uncertainty that happened around the UK leaving the EU, this made the pound to crash by 10% overnight. So in summary, every candlestick you see on the chart is either reacting to one or more of these five forces that makes the market move. So if this video was actually helpful to you, I would like you to like this video, comment, share, and subscribe so that the algorithm will take this video to more people so that they will also benefit. So in my next couple of videos, I'm going to take each of these five forces and expatiate more on them so that you tend to understand these forces so that you'll be able to use them to your advantage when trading the market. So see you next time. Take care and God bless.